Hello, everyone, and welcome. For those of you I haven't met, my name is Matt Petersen. I'm NAGDCA's Executive Director. Today, we're going to follow up our first webinar this year on Secure 2.0 by diving into two provisions that a lot of you have been asking about. That's sections 109 and 603 of Secure 2.0, which deal with catch-up contributions. There's a lot to cover, so we want to get to it quickly. Before we begin, I wanted to let you know a few things. We are recording this presentation, so it will be emailed to you following the presentation. You'll get a recording and you'll get a copy of the slides. So everybody's going to get the slides. Everybody's going to get a copy of the presentation. You will be muted for the duration of this webinar, but please submit questions throughout the presentation in the Q&A box found in the menu at the bottom of your screen. Your questions will only be visible to the speakers, so please feel free to send those anytime. You can start now if you like. We'll get to as many of those as possible at the end. We did get all of those questions that you asked when you registered, so we'll get to a lot of those throughout the presentation as well. We have a chat feature open, which you can use to chat. Those chats are just going to go to the panelists and myself. So if you have something, you can't hear what we're saying or something's wrong, you can let us know through the chat function. Also, we want to thank our visionary and premier sponsors, which you can see here. Without their support, we wouldn't be able to provide programs like this to help keep you informed. So thank you to all of you. All right, joining me today to discuss this important topic are two longtime NAGDCA members, friends of the organization. First, we have Craig Chaikin. Craig is a senior vice president and consultant at Callan. Good to see you again, Craig. And we also have with us today Marilyn Collister. Marilyn is the senior director of regulatory affairs, government markets at Empower. And she's a longtime member of NAGDCA's legislative committee and has been a huge resource to us over the years. So thank you both for joining us. We're really excited to have you here. Two great resources to help you understand this very complicated law. So before we get into today, the goal is to answer as many questions as possible about sections 109 and 603. We got your questions in advance. We'll get to those. One thing I want to address right away from the start is something that you all have likely heard about, and that is the inadvertent elimination of all catch-up contributions through this law. So unfortunately, that is true. There was a technical glitch in the legislation, and we are working through it right now. Marilyn, do you want to cover a little bit what happened and where it stands right now? You're on mute.
Yeah, thanks, Matt, and welcome everyone. It was a conforming amendment in the Secure 2.0 provision that mandates that all age-based catch-up contributions for employees who had more than $145,000 of wages in the prior year must make the contribution as Roth. And when they tried to conform the amendment to section 402, they inadvertently eliminated the section that allows for age 50 and now age 60 catch-ups. So it would have eliminated all catch-ups, both pre-tax and Roth, in 2024, and that was clearly not the intent of Congress. So Congress and the Internal Revenue Service have been notified of this drafting error. And ideally, Congress would pass a technical corrections bill to remedy the error, but getting it through Congress quickly is not likely. So the IRS has been asked to provide guidance that would allow plan sponsors to implement the Roth provision as Congress intended. And at a recent American Bar Association meeting, IRS officials indicated that they are open to working on such guidance and, in fact, are already considering interpretations that would not result in the elimination of the catch-ups. That said, they did not express views about how exactly they intend to resolve the issue. And the retirement industry is working diligently to make this happen. And I know NAGDCA is also working on this, and I'd ask Matt to tell us what NAGDCA's efforts encompass.
Yeah, thanks, Marilyn. We sent a letter earlier this month, as Marilyn mentioned, to the IRS and said, just to put it in plain English, we all know Congress didn't intend to eliminate 50 plus catch-ups with Secure 2.0. That was pretty obvious. So there is a precedent out there of the IRS and Treasury stepping in to say something like, hey, we understand that there was a mistake. We know Congress is trying to fix this mistake. In the meantime, we're going to treat your plan as though they've already fixed the mistake. So we've asked them to kind of go back to that precedent and just treat this as though it's being fixed. Like Marilyn said, we don't know that we do need legislation. We just don't know if we're going to get it this year. And so we've asked IRS and Treasury to step in to not enforce, essentially, as legislation is fixed. So we believe, as Marilyn mentioned, that they are open to our suggestions. So we highly recommend for you as plan sponsors that you plan to implement the two provisions as we're discussing them today by January of 2024. We'll of course let you know when we hear from the Treasury and IRS and update you on any specific guidance we get from them, but just know that that's out there. I know a lot of you have been asking about that, and it's caused some confusion. It is an unfortunate error. It happens. It was a big bill. And so they're working to fix it right now, and we're working with the relevant agencies. So hoping to get it fixed somewhat through regulation, and then we'll go to the legislative process. Okay, so we wanted to get that out of the way first, just so that it was clear. But now we're going to get into the actual provisions of the law. So Marilyn, again, if you would, can you step us through sections 109, 603, kind of talk about what was the case, and now with the new law, what is the case? Because it's a pretty massive change.
Sure, thanks. Yes, Section 109 is an optional provision that allows higher catch-up limits for calendar years when the participants attain age 60, 61, 62, and 63. So under current law, employees who have attained age 50 or over are permitted to make catch-up contributions. And in 2023, that's $7,500. And beginning in 2025, the Secure Act increases these limits for those individuals who have attained age 60 through 63. It's the greater of $10,000, which will be indexed, just like the $7,500 is currently indexed for age 50 contributions. And it'll be the lesser of that dollar amount, or 150% of the age 50 catch-up amount. So in 2023, that would be $11,250. And it's hard to imagine that the dollar limit will be less than the 150% of the age 50 catch-up limit, but it's possible. So we have the two to work from, and it's the lesser of the two. And then Section 603 says age-based catch-ups, that's age 50 and age 60, are required to be made on a Roth basis for higher income earners. So under current law, catch-ups can be made on a pre-tax basis or a Roth basis. But under Section 603, for those employees with wages, which are defined in the law as Social Security FICA wages, and it's wages from the employer sponsoring the plan, exceed $145,000, and that will be indexed. And I think that's important to emphasize that you don't have to aggregate wages from other employers, assuming the participant works for more than one employer. It specifically says it's wages from the employer sponsoring the plan, which I think is very helpful. And if it's $145,000 or more in the prior calendar year, then those age-related catch-ups, whether it's age 50 or age 60 plus, must be made on a Roth basis. All existing plans will have to make operational changes in order to administer in compliance with this mandatory provision. Because if you add age 60, then Roth is mandatory, right? And they need to operate the plan in compliance with the provisions. and work with your service providers and record keepers on administration. But as far as the plan amendments go, the deadline for governmental plans is the last day of the first plan year after January of 2027. So for a calendar year plan, which our 457 plans are, the deadline for actually getting the plan document language amended is December 31 of 2027.
Okay, and there is one thing I want to clarify on our table, and you may have seen we put out some references for secure for government plans. So we kind of had some back and forth on how to classify whether this was mandatory or optional. Like Marilyn said, it's an optional provision, but if you have catch-up contributions, you can't not implement this part. You do have to use any wage over 145 from last year has to be Roth dollars. So you don't have the option to not follow this piece if you're going to offer catch-up contributions. So that was kind of where we got the mandatory if offered language, and that was a bit of compromise language because we didn't want you all to feel like it was optional whether or not you offer catch-ups but follow these rules. They are mandatory rules if you're going to allow catch-up contributions. So I want to be clear on that. Sound good? Okay, well, let's get appreciate that, Marilyn. Let's get into some questions a little bit because we did have a lot, as you can imagine, from even when you all registered. And the main one that we get and completely expected is does this apply to the 457 special catch-up provision? So Marilyn, do you want to cover that one? The answer is no, essentially, but why it doesn't apply?
Why?
So the Roth dollars, the Roth provision doesn't apply to the 457 special catch-up?
Oh yeah, absolutely. That's great. What the Secure Act did was amend section 414V of the code. That's the code section that allows the age 50 and the age 60 catch-ups. But the special 457 catch-up is right in code section 457 and was not impacted by the Secure 2.0 Act. So people can put all of their special catch-up money into the plan pre-tax or Roth as they choose. And that's very good news. Now, the conforming amendment that has a glitch in it has a glitch in the part of the law that says you cannot contribute special catch-up and age 50, 60 catch-up in the same year, but you can defer the higher of those two amounts. There's a glitch in there too that would say you could only do the age 50 catch-up if it's higher, if it was Roth. So that's another thing that's going to get corrected here by the IRS or our technical amendment.
Much appreciated. Okay. So we've gotten, as we would have guessed, many questions. I'll take a kind of easy but not so easy one right off the top is why was $145,000 picked? Our understanding was just kind of that was where the math worked. I don't think there's anything special to $145,000 that I've heard. We did ask Groom about that. They thought it was probably just where the revenue number on the tax bill came from. So I don't think there's anything in particular special about 145. I don't know if either of you have heard any reason they would have landed on $145,000 other than that.
No, well, that's all I've heard, except that there is some chatter about allowing more than just that one definition of compensation, because the code allows the plan to select from 2 or 3 different definitions of compensation. And they're saying if the plan has chosen something other than FICA wages as compensation in the plan, shouldn't that also carry over to whether or not the individual is forced to do Roth? So there again, right now, it's FICA wages unless the IRS gives us guidance to the contrary. That's the definition that payroll systems are going to have to use to track this.
Okay. All right.
Yeah, and I do see a question out there about
Yeah.
whether or not it is mandatory for if you had made over that 145,000 to do the catch-ups on Roth basis. That is correct. That it requires that if your income level hit that, then you have to do the catch-up as the Roth.
Yep. Okay. So we had a couple other, we're going to get straight into questions. We had planned to kind of do some presentation first, but we know there's a lot of questions we want to get direct to them. So one interesting one that we got was from a state plan, and they said, hey, our state statute doesn't allow pre-tax contribution, after-tax contribution. So they don't allow Roth, and they only allow pre-tax. So, they kind of said, what do we do? Because we want to offer catch-up contributions. So, our understanding of it, please either of you chime in, is that you would have to get that law changed. If you want to offer catch-up contributions for folks who make more than $145,000, those dollars do have to be Roth. So you would have to offer Roth. Anything either of you want to add on that?
Yeah, one other kind of a technical thing is that in prior acts, the effective date to amend the plan has been the later of a date or when the legislature meets. If you have to have a change to your legislative dictates your state statutes, but this doesn't. It is pushed out until December of 2027, but they did not put any provision here that would allow extra time for the state legislature to act. So unfortunately, this is really an issue that you'll either have to get the law changed to allow Roth, or you will have to eliminate catch-ups from your plan.
And kind of an interesting follow-up that Moses asked, would the federal law preempt the state law in that regard?
No.
Okay.
No, it wouldn't. And there are some things like automatic enrollment where we've thought, wouldn't it be nice to have a federal law that overrode the state laws? And the states typically don't like that. They would not actually want a federal law that preempted their state statutes.
Yeah. One more quick note on that, since Marilyn, you brought up the fact that in the past, and as a lot of these laws have passed, there's been a provision in there that said, hey, for government plans, we realize there might be a longer timeline because there's a lot of state or local rules that have to get changed. That wasn't included in this one. So I do want to bring up the fact that we're aware of that, and we are working on a technical corrections letter right now to the IRS. We're working on it with the legislative committee. One thing that's come up in that group and our conversations with Groom is, could we ask as part of the technical corrections letter to have that kind of revisited? Because usually there is an extended timeline for government plans to implement some of these provisions. We believe that could be done through a technical corrections letter and wouldn't need legislation, but we're not sure yet. So we are looking into that right now. We're going to discuss with the committee. We're going to continue to discuss with Groom. The IRS might not agree with us on that. If we had to pursue legislation, I don't know if we would. We'd have to decide on that later. So there is the possibility that we could ask. We are engaged with a few plans who might be interested in asking for some extensions on some of this. So we're working through that right now, just so that all of you are aware. Okay.
I think I want to add, unfortunately or not, for a lot of you listening on the phone, you have to really be prepared for a lot of different scenarios. So what we're talking about now is if you need legislative changes to make a Roth viable, or you potentially have to eliminate the catch-up contributions, there's certainly very difficult conversations to have on, both fronts. So it's really, probably trying to prepare on both fronts in the event that one or the other, doesn't necessarily happen. Hopefully some of this technical correction in the letter move things forward in a positive direction for you, but it's hard to not be preparing now in the eventuality that you do have to maybe make a tough choice at the end of this calendar year.
Absolutely. And I think that, we want to reiterate the point that I know uncertainty, and we actually got this question in the registration as well. The question came up, how long do you think it's going to take the IRS to weigh in on some of this stuff? Of course, we don't know. We would hope very soon. They know that this is urgent stuff for all of you. They know that uncertainty is kind of a worst case scenario. We do every year, we go with the board and some of our members to Capitol Hill, and we do lobby in person. We're doing that this year, the first week of May. So our hope is that by then, we can have some of those in-person meetings. We can have all the letters out. We can get some answers, but it's the IRS, so no guarantees. We're going to keep pushing, and we'll get those same answers as soon as we can. But we're kind of at their mercy on how quickly they get back to us. Okay, so we'll continue on with the questions. We got one about, this was an interesting one. So we had a plan that automatically treats any excess deferrals. So anything over the IRS limit for those who are over age 50, they just treat those as catch-up contributions. So the question was, is a participant based on the new law required to make an election for an age 50 contribution? Because they were doing it automatically. It seems like it is, but wanted to defer to the two of you and see if you have any strong opinions.
Yeah, in addition to that question, Matt, we've got some that have said, can we just require everybody to do it as Roth?
Yeah.
So that we don't have to check, we don't even have to track the 145. And it appears in the Secure 2.0 Act and in talking with outside counsel, including Groom and others, it specifically states in section 603 that they're adding at the end of section 414V a new paragraph, and it's called certain deferrals must be Roth, but it also indicates that an employer plan must comply with the Roth requirement, but must also allow any eligible participant to make his or her additional catch-up deferrals as Roth. So they're saying that each employee gets to make an election unless they're over that 145,000 limit, and then it must be Roth. And then there's another section entitled election to change deferrals. And so it says, let's say a participant has made an election to do pre-tax catch-up contributions. And then the next year, they're over the limit. This says those people must be given the option to change their election to Roth. So I'm concerned that all these automatic features here will have to go by the wayside, and we will have to have actual elections from participants to elect age 50 as pre-tax if they're under the income limit, or to change to Roth if their income goes over the limit. That's going to be some administrative issues there.
I would think so. I'm gonna get to one more question, Craig, and then I do want to talk to you about how we're going to put this stuff in practice and what are some of the things that people have to think about, depending on their situation, whether they have Roth now or they need to get Roth. But one that we get often, and a few are on the Q&A, and we got a few before the event as well, is how do I verify somebody's income? What if they're a new employee? How do I figure out whether they're across the line of 145 or not? I think that could be, it's hard generally. And another kind of related question from Kelly is for multi-employer plans. So there are a lot of state level multis out there who, allow political subdivisions to participate in their plan, but they don't necessarily have visibility on their payroll. They just get a contribution from those individuals. So kind of a two-part question that's a very difficult one and very important for this conversation is how do you verify that money, especially if they weren't employed with you last year? And then for multis, how can you work with some of your political subdivisions to get a process in place?
Yeah, this is a difficult one, and I would suspect that the IRS will give us some guidance. But just looking at the words that are in the provision, it says it's wages from the employer sponsoring the plan. So will that mean that if you hire a new employee, that you don't have to worry about it until the following year? And then you would be using your own payroll to determine whether the employee was over the 145 in their second year of employment. I'm hoping we'll get guidance from the IRS on that. But if they say from the employer sponsoring the plan, that says to me, you don't have to go back to the prior employer or get the employee to send in their 1040 or anything like that, that you would just be working with your payroll system. And perhaps the first year that someone's employed, they get a pass. And hopefully the IRS will help us with that. Now, with regard to state plans with participating local governmental employers, it would appear to me that the responsibility will fall on each employer to verify the income received from that employer and provide that information to the state plan. And here again, we've talked about payroll systems, but they would need to be upgraded for this purpose, perhaps. And I think everyone needs to look at the joinder agreement or whatever they call the participating employer agreement, the agreement between the state and each employer that the employers sign in order to participate in the state plan. Now, several that I've seen do have specific employer responsibilities that the employer has to acknowledge, stay with them. Verifying termination dates, sending in the contributions, taking the deferrals out of the paycheck. I think this would be another one that would be an employer responsibility under those agreements. And then they'd be required to provide that information to the state so that they can administer the plan properly.
Okay. So, and then I suppose that would just kind of be a yes, no line, or would you expect to see a number with that? I don't know, Craig, if you're working with any plans that are going through that process right now, trying to think through it, is it just, are you above or below the 145 threshold? Yes, no, or would there, I suppose there's a lot of different ways you could crack that egg when you're trying to implement it.
Yeah, sure. I mean, I think to Marilyn's point, it's probably going to require some pretty significant payroll updates really across the board in terms of how you are sending money over, potentially a little bit more communication on it. But I think certainly the way the law is written now, it's that it's 145. If you're above, it's X. If you're below, it's Y. So as we would typically counsel plans, follow law as it's written, not with the flexibility that you might prefer.
Yeah, and I think it's going to fall on the employer because they're going to have to send the contribution into the plan, into the record keeper, either on a pre-tax or a Roth basis, which means that they have, if it's on a Roth basis, they have to take out the income tax on the way in, just like they do with their other Roth contributions that people have selected. So they're going to know how to do that, but they're going to have to take out the income tax on the Roth contributions and then send those as Roth into the plan.
So I know in past discussions that I've had with sponsors about just adding a Roth feature, especially for some of the larger state plans that have subdivisions, maybe smaller employers, that both the time and the money to update payroll to allow for Roth is a potential headwind to getting them added. I will say, maybe a silver lining to this is that if you do continue to allow you have a lot of catch-ups, you continue to allow catch-ups in order to comply with this law, because the Roth feature is required as part of these provisions, it is likely that you would be able to use plan expenses to maybe offset some of the cost of updating systems. Where in the past, that decision to add Roth was an employer decision, and so you were not able to use plan money to cover the cost of maybe any updates. We do think, and we had this conversation with Marilyn, that you'd be able to use plan expenses to cover that, which at least takes out some of the headwind for implementing something like this.
Yeah, there's some good guidance on that, Craig, from the DOL. They put out an employer versus plan expense guidance document a few years ago, and in scenario 4, they said, okay, we have these new tax acts and they require us to amend the plan. And so we want our outside counsel or our consultant to come in and work with us so we can decide which provisions we should adopt. And then we have the expense of actually amending the plan, as Craig said, to add Roth. And the DOL concluded that talking about it with your consultant or your outside counsel and trying to decide, and the employer decide, what are we going to add or not, would not be a plan expense. But as Craig said, if you've got catch up, you've got to have Roth, and the DOL agreed that would be a plan expense. So we do have some guidance to back up what you're saying there, Craig.
Always good to have some guidance to back up the claims.
Oh, yeah. Even though the DOL doesn't apply to
Right,
governments,
right.
it's still the right type of guidance that is very helpful.
Yeah. So a couple more that just to clear up and to make sure that people understand some of the nuance here, because it is a very confusing provision. So question pretty straightforward. If you made over 145, and this would be a difficult payroll aspect as well. If you made over $145,000 last year, your contributions, your regular contributions can still be pre-tax, correct? Your catch-up contributions have to be Roth. All of your catch-up contributions. Is that stated correctly?
Right.
Yes.
Yeah.
Okay. So just so that it's clear, it is not all of your contributions that become Roth. It is just your catch-up contributions. If you're over the salary threshold from the previous year, that would have to be Roth. And those do have to be Roth if you're in a catch-up. You're doing a catch-up. So one more, is that gross income or net income that the $145,000 is based on? Do you know that?
Well, it would be compensation. So I don't see what would be net. I mean, it's not like you can take out your deductions and you pay tax on
Right.
something less than 145. It's whatever compensation was received by the employee from the employer. And I saw a question there. It says, well, what if our entity does not pay into FICA? That does not impact this at all. That's just the definition they're using. And that's also why we've heard some talk about getting the IRS to allow other definitions of comp that are currently allowed for plans to use. But you would, and there again, it's the definition of FICA wages that you're looking for, not whether or not FICA taxes are paid.
Yes. And also, to be clear, for the 60 plus catch up, so you have the $10,000. If you made over 145 last year, those catch up contributions have to be Roth as well, but your normal contributions can still be pre-tax, correct?
Right.
Okay. All right. So it is just figuring into the catch up portion of your contributions. Okay. So let's get into the implementation of this stuff a little bit, because we'll continue to talk through some of the details of the law, but I think it's important to think about, what do you need to do? And there are really two buckets of folks out there. One is those that already have Roth, and the other is those that don't. So from our data, I looked at the plans that we have data on. It looked like about 20% of all the plans, all the voluntary plans that we have data on, do not have Roth currently. So this isn't a small pool of folks who's having to make a decision on whether or not to add Roth. So Craig, let's talk about some of the practical implications for plan sponsors and talk about it in those two buckets. So first, if they have Roth, let's talk about two things: the plan document and the payroll. What kind of changes do you need to make or think about as you're going through this process and considering all of the different nuance of these provisions?
Sure. I think I'll add another, quick nuance to that as well, is whether or not you have catch-ups, right? So if you're not currently offering catch-ups, you have no interest in adding catch-ups, so you're probably not on this call, I would suppose. But, if you don't have catch-ups, a lot of this is, certainly not applicable to any of your changes. But I think, these responses assume that you do have catch-ups and want to continue offering catch-up provisions. So, if you do have a Roth source already, I think your lift is probably a little bit easier from that perspective, but it very likely does require some changes to the plan document to accommodate some of the updated language. I think, as Marilyn had noted, participants, do potentially have the option of designating their catch-ups in certain manners. You probably, though, need to add specific language for the 145,000 catch-up and then the 60 plus catch-up provisions. So you'd likely need to update your plan document for that. I think the jury is still out on exactly how this information goes over to the record keepers. I think a lot of them are still working through that process, but it's very likely going to mean that you might need to identify additional money sources on your payroll file, whether or not it's 50 plus, if it's 60 to 63, where they fall, some in that catch-up spectrum. So it's possible, if you do have Roth, that you would still need to make some payroll updates to accommodate for the expansion of the catch-up provisions.
Okay.
Do you want me to cover non-Roth as well now?
Yeah. So let's go
Okay.
into if you don't.
So, certainly if you're not offering Roth source right now, it's a big lift. Many of you that are on the call potentially have legislation that we discussed earlier outlining the specific contribution sources. So it does take legislative change to allow for something like this. But then certainly adding a Roth provision means the payroll needs to be able to account for it. So you have the payroll issues as well. Oftentimes for things like this, we tend to see these things being discussed in committee and then decisions made in terms of how to move forward with that. Even though the employers technically, in a lot of these instances have control over the types of money sources to ask, it a lot of times starts with the committee. And then the committee potentially has to move that forward to the employer, depending on what the governance structure is. If you do need to make legislative changes, we've touched on that already. It can be a pretty heavy lift. The timing might not necessarily line up for you, especially on provision 603, since there's a little bit more time for provision 109. But certainly allowing Roth, very likely requires plan document changes as well to allow for the different money sources, the payroll adjustments. And then, certainly if you have smaller employers, there's not just one or two major employers. You would need to coordinate that or get that implemented across really all payroll sources in order to move forward with this.
So no small undertaking. Okay. And that's why we're all here. Another good question came in, and this one was from Ashley. It kind of goes back to the multi-employer verification. We got a similar question from another state plan in a different meeting that we had. And it was related to people who may have money coming in from the same different entities under the same employer, right? So take, for instance, a professor who might be splitting time between two colleges, but they're under the same university system. So they're getting paid by one college and then paid by the other college, but it's the same plan sponsor who would have jurisdiction over that plan. What would a plan sponsor have to think about for integrating those payrolls to get that total compensation? What are some of the kind of practical logistics? Because I do believe you would have to account for both of those, correct? If both of the sources of income are going to the same plan. Does that make sense?
So I know we have some plans that where they work for, it's a different employer, but it's still part of the state. They're still working for the state. That may be an issue, but I really think we're going to have guidance from the IRS to know whether you have to aggregate different employers under the same plan. Because right now it's saying from the employer. So I don't know if aggregation is going to be necessary. Now, I do know that if you work for one state entity and you go to work for another state entity and you're both in the same state plan, you're not treated as severed from service because you're still with an employer under the same plan. So they have made you sort of aggregate in the past. So Matt may very well be onto something here that they'll make you aggregate in this situation. But I don't think we have anything to tell us how that will work just yet.
Okay. Craig, anything you want to add?
No, I think that's, consistent with what our discussions have been. I do think, to what I said earlier, planning for multiple scenarios, if this is something you think you want to move forward with, absent of any, potential guidance, it might be worth looking at communications processes between some of the underlying entities to see if you can make that a more seamless process to potentially aggregate.
Yeah. So a good question here that, section 109 is pretty quirky. It's just age 60, 61, 62, 63. What happens after 63? If you're not in those 4 years, do you go back to the age 50 special catch-up? That's my understanding. Is that consistent with what both of you know?
Yes. Mm-hmm.
Okay. So another consideration for your payroll and kind of how you implement this is that if somebody does stay in employment beyond age 63, that limit has to go back down, and you would have to communicate that somehow and let them know, right?
Yeah, participant communications, and I'm sure Craig knows a lot about this, will also have to be, really clear and changed so that people know. And then I've gotten questions, well, what if I turn 64 in the middle of the year? So I'm 63 for the first half of the year, but then I turn 64. Well, it's the calendar year in which you attain these ages. So even if your birthday is in December, let's say your birthday's in December of 2025, and you're going to turn age 60 in December of 2025, you can put the age 50 catch up in all year. That's your calendar year when you attain that age. So the calendar year when you attain age 64, even if it's the middle of the year or the end of the year, you have to revert back to age 50. It's the calendar year in which you attain the ages where the catch-up applies.
Okay, so that makes it even more complex because you couldn't just go by the age that they are at the moment. You would
No,
have to look and see when what their birthday is.
and that's pretty consistent, like for the exception to the 10% penalty, which doesn't apply to 457, but it's the calendar year in which you turn 59 and a half. It's the calendar year in which you turn, used to be 70 and a half for RMD, now it's 72. So
Right.
that's pretty consistent. If you're going to attain that age anytime during the year, you get to use the catch-up, or you have to revert depending on your age.
Okay.
So Matt, I don't want to steal your thunder on the questions, but I see one that I think is, certainly worth clarifying what our current understanding is. And that's if you do currently offer catch-ups, but do not offer a Roth and don't think you will have Roth implemented in time to comply for 603, which is the 145, but that needs to be implemented by the end of the year. Our understanding now is that you would have to stop catch-up contributions if you are not able to accommodate the Roth money source. So it's unfortunate. It's unfortunate and certainly not, good news, but that's what our understanding is of the rules right now.
Yeah, I agree. And that's we did have that one come up before in some previous conversations. That's our understanding too, is that if you don't have a Roth option, you can't offer catch-ups. And another similar-ish question from Kelly, I think you mentioned this before, Marilyn. Maybe the easy way would just be to say, hey, everybody's Roth, and that way I don't have to verify income. Can you go that route for catch-up contribution?
According to the section in the section 603, it specifically says that you have to allow all employees to elect Roth. And you have to allow them to change from pre-tax to Roth if their income is over that limit. And in talking with outside counsel, they don't think it's possible just to say, if you want catch-up, it has to be Roth, because this section specifically says that employees get to make the election. But there again, we'll see if the IRS provides any other guidance on that.
Yeah. Well, and I think that's kind of a nuance to what the rules are now, is you can move people's money to catch up, but the way the law seems to be worded is people almost have to make an election in terms of the desire to do catch up. I know one of the discussions, we had earlier was if somebody's contributing extra, if you're just rolling it into that catch up, but you don't, let's say you don't, haven't had Roth, do you have to return that money in the future, in lieu of making that decision, but then passively making that decision?
Okay. The one point that I want to clarify, this is a good question about the dates. So we've thrown out a couple of dates. One is the end of this year, beginning of 2024, and another is 2027. So I just wanted to be clear about what is driving those two dates. So what has to be done at the end of this year, and then what has to be done in 2027?
Well, yeah, anything that's effective this year or in 2024, whenever it becomes effective or whenever you choose to offer it, if it's optional, and you have to adopt those changes, you have to start operating the plan in compliance with the changes. It's the actual typing up of the plan document, the actual plan document amendment that's not due until 2027. But you do have to adopt each provision and start operating in compliance with it when it's mandated, or when you've adopted an optional provision. You have to adopt it early. It's only the plan document where you get to wait.
Okay. Hopefully that clears that one up. I know we're throwing out a lot of numbers and dates and things, so hopefully that one makes sense. So this is a really good one, and this is one that I had thought about before. We're saying essentially you have to make an election. The participant has to make an election here to do a catch-up contribution. As part of that election, could you also put in a piece that says And by the way, did you make over $145,000 last year? Could that qualify as your verification of their salary from the previous year?
Well, there are a number of provisions in Secure 2.0 which specifically allow employee self-certification. This is not one of them, unfortunately. So unless the IRS would say, well, if they weren't employed by you, so you don't have that information on your system, this is their first year of hire, you can rely on self-certification for the prior year when they didn't work for you. I can see them maybe saying that or saying you don't have to worry about it. But unless they change, they've been so specific with those where you can self-certify, like hardships and domestic abuse and those types of things. This is not one of them where they allow you to take the employee's word for it.
Yeah, I think it is. And I see one of the comments in here. It will be interesting to see how record keepers ultimately accommodate some of this, because if you are passing over salary data, and I know not everybody does pass over salary data, it is potentially something the record keeper, could track and provide information on. I don't know that I would necessarily count on that as a solution for verifying some of the income.
Okay. So this is one, Marilyn, that you and I talked a little bit about, and I think it's one that's important to flesh out a bit. So let's say your plan offers catch-up contributions. You say, yes, and you have Roth, you say, yes, we're going to offer the 50 plus catch-up. Does that mean inherently that when that person in the calendar year that they turn 60, as we talked about, when they turn 60, they automatically move to the limit for the 60 plus catch-up? Or is that something that you can choose to allow or not in your plan if you decide to use catch-up contributions?
Well, this may depend on the plan document providers and how they draft it. I think it would be possible to draft a provision that says you're complying with section 414V, and that would include both the age 50 and the age 60. You could say in the document, will automatically go up to the age 60 unless they opt out. Or you could say we're going to require an election for age 50 and a separate election for age 60.
Okay.
I think it's possible to draft the document either way. And knowing though that when it's mandated to be Roth, if someone's been getting pre-tax all the time, the act indicates that you might have to allow them to elect Roth. I mean, could you automatically just switch a pre-tax election to a Roth election? I think that's where the difficulty is going to come in.
Okay. What about, this is also a good one. A lot of good questions today. Is it a one-time election that we're talking about? Or is this every year? So if I'm 50 and I made over 145 last year, and I say, hey, I want to do catch-up contributions and I'm doing that, can I continue to roll that over into the next several years?
I would think so, yeah.
Okay. So we don't have to re-up that that election each year, as far as we know.
Yeah, and here again, this is more impacted if you were automatically increasing people if they contributed too much. And now I'm thinking that may not be how it works, that you can just automatically do that, because some people will have to move to Roth if they've made too much money. So it may just be that they elect to do age 60, and then so long as they are actually sending you more money than the age 50 amount, they're doing age 60 catch-up. You wouldn't have to ask them every year.
Right. So what you're saying, if I am right, hopefully, is if you are changing, if your salary changed, if something in your circumstances changed where you went from a pre-tax to a Roth, that would initiate another election. But if you were just say pre-tax every year, say you make 70,000, you want to do catch-up contributions, you do a one-time election, you wouldn't have to re-up that every year if the plan sponsor is kind of monitoring your salary to make sure you didn't go over those thresholds and that kind of thing. Is that correct?
Yeah, if you were automatically doing it before, it worked very well. You just kept putting these extra contributions in
Right.
as age 50. But now for those that have over 145,000, it's not, according to the statute, it doesn't look like you would just decide to automatically switch somebody from pre-tax to Roth. So it'll take some, working with plan document providers and determining, how it will work best.
Okay. Yeah, and we did get another question from another plan that automatically enrolls you essentially in over 50 catch-up if you do exceed the IRS limit. And it sounds like you're going to have to make a positive election in order to go into that. Is that correct? That's what we're.
I think that may be the way it ends up.
Okay. I think we have time for maybe one or two more. I don't know if there are any that
I
feel
saw
about.
one about 403Bs.
Yeah.
And they're asking whether the 403B special catch-up is impacted, and the answer is no. It's just like the 457 special catch-up. Those are fine. They can be pre-tax. It's only the age-related ones, age 50 and age 60, where Roth is required.
Okay. All right. I think we're going to leave it there for now, but I did talk to Craig and Marilyn before this to see if they were open to an idea. We haven't really done this before, but I know this one's causing a lot of issues, and it's causing a lot of issues that are very specific to your plans that are maybe helpful to talk through. Hopefully we've gotten through most of those questions this hour, but they were kind enough to offer some time tomorrow. If any of you are interested, we would probably do it in more, we wouldn't record it. It won't be a presentation. It'll just be kind of a Zoom meeting like we do our Connect exchanges, to sit down. If you still have some stuff that you want to work through and go, hey, I have this very specific question that you all didn't have time to get to, or was a little too deep to get into just on this hour. Tomorrow at 2 p.m. Eastern, they were willing to sit down and step through some of those if you'd like to join. So we're going to open that up. It'll be a link that's in the follow-up email to this presentation. So you'll get the presentation, the recording. There'll also be a link to join that meeting if you want. We encourage those of you, if you're still a little befuddled, or if there's still some things that you have for your plan that you'd like to work through, we'd love to hear about them. So we'll send more information on that. Hopefully we got to as much today as we could. We packed a lot into the hour. This was a tough one. So Marilyn and Craig, thank you very much for joining us. We hope you all found it valuable, and we'll see you again next time. Thanks a lot.